I'm a big fan of the nation's indexes. So if anyone reads our daily notes, they see we often talk about the SDEX, which is the Skew index that you guys have modified. We're big fans talking about VOLI, the TDEX index. TDEX is another one. So we're constantly talking about your indices, and I'm extremely excited to talk to you, especially on a day like today when markets are going crazy and these volatility metrics are really displaying some important information.
Yeah, Brent, thank you so much. The business nation's indexes got started from our proprietary option trading expertise. So I was a market maker in options on the floor of the CME for 25 years. So during that time, I was one of those crazy guys in a bright red polyester jacket, jumping up and down and making markets first in options on the treasuries and then options on the S&P futures. And as markets evolved and as we moved upstairs, we came to realize that we wanted some tools that we could use to help us understand and visualize what was really going on with implied volatility. And so we started creating the indexes that people know about. Some of them we publish, like VOLI, SkewDex, TailDex. Some of them we don't publish intraday. And again, we created those to help us understand how markets work. For example, VOLDEX is purely at the money implied volatility, closed form solution for that. And as an example, we started that, Brent, because whenever we walked back into a trading crowd or sat back down at a trading desk, the first question that you would really ask is, particularly if you walked into a pit or a crowd, was what's the at the money implied volatility? And you can see that right there. What's the at the money implied volatility? And that's the way people started building their understanding of the option markets. And from there, you could add your own understanding what was going on with the out of the money. But really, at the money is where it all starts. And that's why we created VOLDEX the way we did, to exclude some of those deep out of the money options that really have a life of their own. They're not a true measure of what's going on with implied volatility.
Yeah. So if I can interrupt you quickly, I have VOLDEX and VOLI on the screen. So just to be clear, the difference between VOLI and the VIX, VOLI looks at only at the money volatility in the S&P 500, right, in the SPX options, whereas the VIX measures all options, right, in the S&P 500 complex. And so, not to jump right into sort of the meat of it here, but since we opened with VOLI, I've been excited to ask you this question. Oftentimes, we'll see people talk about dividing, say, the VIX by VOLI, or some people subtract it. There's a bunch of different ways.
Sure.
You know, why would somebody do that, and what's the value of that information?
Sure, that's a great question, and this goes into really the question of skew. You know, we as option traders or option practitioners, we all love to talk about skew. And that is the fact that implied volatilities change as we move from at the money. And the shape of that skew, or smirk, some people call it, can really be instructive, but you have to be able to measure skew. If you're left saying, well, there's a little, or there's a lot, or that's not very helpful. So you have to be able to quantify it.
Right.
And so, to your direct question, why would somebody say take VIX minus VOLI and then normalize that by, say, VIX, by dividing by VIX? Why would somebody do that? Because that quantifies how much input all of those out of the money options are producing. And so it's another measure of skew. It's a different measure of skew. You know, we can all agree on the right way to measure implied volatility. We might disagree on the very edges of the calculation, but we all know what implied volatility is. With skew, there's no centrally agreed upon way to really measure it. And so, for example, SkewDex, SDEX, we calculate the implied volatility for the one standard deviation out of the money put in SPY. We subtract, and then we normalize by the at the money vol is really the way it works. And so that's one measure.
Yeah. So in this case, when you look at the chart of VOLI divided by VIX, VIX divided by VOLI, which is this chart that's on your Twitter feed, by the way, at Scott Nations, is a wealth of volatility information for those of you interested in there. But you see how skew basically, or this measurement, right, of skew is down around lows that rival, say, 2019, certainly before the COVID crash, right? And what's interesting, right, and I hadn't really thought about this until you just sort of mentioned, but the SkewDex, the SDEX, is also kind of in that same range right now, right? It's like they're measuring essentially the same thing.
Yeah, they're measuring essentially the same thing, slightly different ways of looking at it. And TDEX does as well. That ticker symbol is TDEX.
Right.
And that's the normalized cost of a 30-day, 3 standard deviation out of the money put. And we call it TDEX because that 3 standard deviations out of the money is really kind of the threshold at which people agree a tail event is occurring. So TDEX is the cost of insuring your portfolio against a tail event during the next 30 days.
Right. And so do you have a general opinion on why, Skew is positioned the way it is? I mean, in the last few days here, you can see the tail dex starting to spike. It's like it's starting to wake up now. Like I think some of these, central bank scares, particularly probably in Europe, are waking up, some people wanting some downside protection. But do you have a general, view as to why the Skew index and stuff like that is pinned sort of towards the low of the year?
Well, I think that they got low recently because people were relatively unworried, complacent about what was going on. And if they were going to buy a little bit of protection, they were going to buy just a little bit, but they were going to buy at the money put. So they weren't preparing for something really serious by buying out of the money puts. And so since there was less buying in that range of like 1 to 3 standard deviations below at the money, we saw those measures come in. And that actually tells you a fair amount.
Yeah, I think you're completely right about that. There's been a couple of interesting discussions on your Twitter feed, about different reasons why the VOLI, why this sort of measurement, the Skew measurement, VIX over VOLI, is so flat. And another good point that was brought up was the fact that when the entire volatility curve shifts higher, right, that the wings are sort of not priced as high relative to the belly, so to speak, right? So the like Skew flattens out, or the term structure, I guess would be the Skew flattens out in that case, which makes the wings relatively not as expensive as the belly, so to speak.
Yeah, and you also have to remember that, for example, all of our indexes, SkewDex and TailDex, they measure out of the moneyness, that is 1 standard deviation or 3 standard deviations out of the money. They measure that by the cost of the precisely at the money option.
Right.
So we use that to calculate a standard deviation rather than saying, what was the realized volatility over the past 20 days or 50 days, that's stale. We don't want to do that. We want to have the market right now tell us what a standard deviation is. But that also means that as VOLI increases, those thresholds for 1 standard deviation out of the money or 3 standard deviations out of the money, they get further away. And so that's one reason that you see this phenomenon also. But again, last week, everybody decided that their previous approach in August had been incorrect, and they really started reaching for out of the money puts as protection.
Yeah. No one wanted to sell puts into the Bank of England going belly up.
There you go. Yeah.
So I'll be remiss if I don't ask sort of, and I know the question is going to come up. And by the way, anyone that has questions, please put them in the Q&A section. There's another Skew index out there. Could you comment briefly on why the SDEX is different from that other Skew index?
Well, let's go ahead and share it with everybody. I'll say it if you don't want to. The index I think you're talking about is Skew, SKEW is the ticker symbol, right. And it's calculated by SIBO, and it really does not measure Skew in the way a few minutes ago I said there are several ways you can measure Skew. Well, SKEW measures it in a way that's really, really goofy. I don't know of any practitioners or academics who believe that that's the right way to measure Skew, or even a legitimate way to measure Skew. And another problem is Skew is only calculated once. It's calculated at the end of the day, which doesn't do you very much good. So I don't think I'm beating up on SIBO when I say that I think that they really missed the boat when it comes to the way they calculate this. And it's just not the right way to do it. I will say again that there is more than one legitimate way to calculate Skew. SKEW isn't the way to do it.
Right. And there's some interesting discussion about that. But if you look at basically the math of the Skew index, they use a SPX standard deviation, and they're essentially the denominator of the calculation. And basically what happens is that standard deviation rises and falls. That can lead to some aberrant calculations, essentially, as I understand it.
Yeah, and again, it's been a while since I've looked. They don't calculate it until the end of the day, which doesn't do you very much good right now. it's around noon and the market's down a bunch and you'd like to have some insight. One other index I do want to talk about real quickly, though, is VOLQ.
Yes, 100%.
VOLQ uses our VOLDEX methodology applied to NDX options, that is NASDAQ 100 option prices. And VOLQ futures trade at the CME, ticker symbol is VLQ, and VOLQ options are trading on all of the NASDAQ options exchanges. So if you like this methodology, and I think that there's a lot to like, then in the NDX world, there is a way to actually express your point of view through futures and options.
Yeah, and I know from our talks with the NASDAQ, they're good partners of ours. I mean, they're really excited about this product and the futures on these products. And again, it's exciting and nice to have this sort of clean measurement of NASDAQ.
Well, the two indexes, the S&P 500 and the NASDAQ 100, are different. They're very different. And so you need to use the volatility measure that is appropriate for your portfolio. And Brent, the interesting thing is portfolios are starting to look more and more like the NASDAQ 100 and a little bit less like the S&P 500. And why is that? It's because, for example, Apple's done relatively well this year. And so if you own Apple in your portfolio, it's a bigger portion of your portfolio than it was at the beginning of the year. And it's the biggest name in the NASDAQ 100. And so that's why I say more portfolios are starting to look like the NASDAQ 100.
Right. And Apple is the biggest beneficiary of capital inflows in the world, I think, with the all the ETFs it's in and being the largest constituent of the S&P and the NASDAQ. So it's the performance of that stock is really pretty amazing this year, given the kind of carnage across the board. You see it's not really all that far off of all-time highs, relative to some of these other measurements.
Right.
So you had this very interesting article I'd point everyone to, and I could put this in the chat. This is on the Wall Street Journal, measuring sort of this idea of the fear gauge. And then again, looking at the spread between the VOLI and between VIX and VOLI. Again, there are some people who, and if you're comfortable talking about this, the VIX is essentially a measure of a variance swap, right? Or a variance. And so again, could you kind of walk people through that idea and that concept? I think it's a very interesting one, and sort of the difference between what that may actually be measuring versus VOLI.
Well, you mentioned earlier that VIX uses essentially every out of the money option in the two constituent expirations. And that includes a bunch of deeply out of the money options, a bunch of deep out of the money puts. As long as it has a non-zero bid, it's effectively going to be in the VIX. And not just that, but those deep out of the money puts, which really are not an expression of what's going on in the market, have outsized influence based on their cost. That is, if you look at the price of that option, the further you get from out of the money, the more the weighted exposure it is in the VIX. And we consider that to be a fundamental flaw in the VIX, which is why we created VOLI. So VOLI is a volatility measure, implied volatility measure, and VIX is really a measure of variance. And without getting too much in the weeds, there's a difference in how you might build that portfolio to hedge or replicate either of those. But they have tremendous correlation to each other. They're very similar, but when they diverge, we think they diverge for important reasons. And it's then when VOLI is by far the more appropriate measure.
Right. That makes a lot of sense. And the discussion around, again, you'll find some on Twitter, some discussions around these sort of different measures. And I think for the trading application of most people, certainly on this call, it gets, pretty deeply in the weeds, but I think it's really quite interesting what the two are actually measuring. Turning sort of slightly, one of the things that we talked about that you do is pretty cool is this term structure, the term DEX you call it. I know this is something that you're very excited about. I found it really quite interesting. Can you kind of walk us through what this is and sort of why you think it's valuable?
Sure, and we do not publish this intraday, but if you follow either me on Twitter or you follow the company that's at nations_indexes, you'll see us post this quite a bit. And this term DEX is a single number that quantifies essentially the term structure. Now, term structure, the version you see there on your screen, where short-dated options are relatively more expensive on an implied volatility basis. When those are more expensive than longer-dated options, We refer to that as term structure inversion, because this is not normal at all. It normally looks very different. Normally, short-dated implied volatility is lower than long-dated implied volatility.
All right, so we'll get something like this instead.
Yeah, exactly. And so when you see something like this, you know that the world is not, if you will, normal. And so TermDex quantifies that number, calculates and quantifies that number. And if you go to our website and under the tab Index Values, you can see the historical values for TermDex and actually all of our, there we go. Over to the right one, the nation's index values. And you'll see there, if you click on that, and you'll see that you can download. And we try to update those monthly. They're more likely to get updated quarterly. But that's a way that people can actually see those values and understand what is normal. And if you actually go to my Twitter feed, pinned to the top of my Twitter feed, you'll see, there we go. You'll see, there we are. You'll see an animation of term structure. And that blue line is what is normal. That's the average. And the red line is what was going on in the middle of September. But that blue line is the average shape of SPY, implied volatility term structure.
This is very soothing music for what's going to ultimately end in a pretty nasty crash.
well, we have a neat team that puts that together. I'm not a very musical person, but they thought that would be really interesting. And so we think that that's a really interesting way of looking at term structure through time, so that you can see what's normal, but you can also see what happened, say, in March of 2020, or February of 2018, when things got really crazy.
That is pretty neat. And so a lot of us are probably familiar with looking at maybe like VIX Central, right? And you can see the VIX curves and term structure. And I like this because of the fact that VIX term structure can do some really weird things around expiration, as sort of the future and the index kind of sync up. And what I like about this is the expiration term's a little bit shorter. And so, do you have that same effect where the expiration is going to affect kind of the starting edge or the leading edge of this measurement?
It's not so much the expirations, because again, we use SPY options, and there are enough expiration dates that expiration is not really a problem. What you'll really see sometimes are catalysts. Catalysts will really get this out of whack. We saw that just before the last Fed meeting, as an example, that the term structure will get a real weird kink to it, and that's because everybody wants to own options of a certain maturity to catch the catalyst.
Right. So I guess the way I should have stated is that you'll have the settlement issue in that will reflect in the VIX term structure there, like when you look at a VIX Central, right? Because the index and that front month future have to settle together. And I think that can skew the data there a little bit if you don't kind of account for that. And then there's also oftentimes weird things where there's an extra day, right, in the VIX calendar or whatever, and that can lead to some weird kinks in that curve that aren't necessarily related to like the event vol kind of stuff you're talking about.
Well, and part of the problem is that, to your point, is there are a finite number of VIX futures expirations, and for our purposes, there's essentially an infinite number of SPY option expirations, and so we rarely see that sort of a problem. And TermDex is just if you go, the fact sheet is on the, and so if you go to volatility, there you go. Click on that, you'll see the fact sheet, and yeah, they're at the bottom right on the second page. You'll see the predictive value that TermDex can have, and TermDex is really just a quantified measure of the slope, the best fit slope of that term structure from 7 days out to 360 days, and it has a tremendous amount of predictive value about what's going to happen in the S&P over the next 20 trading days.
And so in sort of the most extreme of events, like, March of 2020, I mean, how high have you seen this skew measurement read? Like, what can you give us kind of rough sense of backwardation, maybe where the front would be, versus stuff that's farther out?
That's a good question. I don't, not off the top of my head. Again, if you'll play that video all the way through, you can see. I guess
they do give it to us there, yeah.
Yeah, and we don't need to play it now because it will take a while. But I will bet that well, we're close. I would bet that 7 day number in March or April of 2020. There we are.
Ooh.
I'm going to bet that got
Oh,
up
look
to
at
about,
that.
yeah, I'm going to bet that got up to about 90 at some point.
Yeah, that line right there is about 90. I don't know exactly where I snapped it. So that's
Yeah.
the time series versus the average today. So I must have just missed sort of after the Powell came out and saved the day, or OPEX saved the day, or however you want to look at it.
So yeah, I bet you that 7-day value got to 90, if not close to 100, and that that makes sense. It looked like the world was coming to an end, and who knew how that was going to work out, and so you can see the extremes.
Yeah, that's really quite fascinating. And it's nice you can download this data. We find that people just love that downloadable data where they can play with things themselves and get used to all the different flavors of the market. So, and I guess also on this point, one thing I should bring up is topical is in the next month, there's a CPI reading on 10/3. There's I assume a cast of earnings over the next 2 weeks. Then we have the ECB on 10/27, the FOMC on 11/2, the Bank of England on 11/3. I think there's an election in there somewhere. So in the next, say, 30 days, this chunk of the curve, there's not a whole lot of reason for this to deflate or to really shift sharply into contango, in my view, right? I mean, I know there's a little bit more of a forecasting exercise, but how do you sort of look at that? How do you think like event vol may factor into holding this up versus, kind of real fear in the market like we have now?
Yeah, that's a great question. I think right now it's clearly, and when we're done, I'll post the absolute most recent value on my Twitter feed, and it will be up to the minute. Right now, everybody is buying all these short-dated options because they're afraid. And let's face it, people buy short-dated options because they're afraid. But right now we're afraid that the market's going to be down another 100 points tomorrow or the next day or whatever. But you make exactly the right point that people are going to be afraid of different things just before the next CPI or PPI release. Probably going to be afraid of different things the first week of November. So I would be very surprised if this got back to normal contango where the 7-day implied vol or the 7-day VOLDEX number was very much lower than, say, the 30-day or the 60-day. That would really surprise me because that would be a sign of complacency. And we, as investors, we have pretty short memories, but we don't have memories that are quite that short. So if that were flat before the next catalyst, I wouldn't be surprised as long as the S&P has kind of moderated its decline. But again, I'd be really surprised if we had that big typical swoop lower left to upper right sort of shape.
Like a real flush or release. And I guess sort of related to that, something that just kind of popped in my mind here on the TDEX index. I mean, this has been a pretty substantial move up, but these moves are probably relative, right? I mean, we shouldn't really anchor the value here to this value, back in December of 2021, right? Because is it the relative move that occurs that's a big signal here, as opposed to sort of like the absolute level on the chart? If that question makes sense.
Yeah, no, I think that's fair. Let me put it this way: it's easier to go for TDEX to go from 10 to 15 than from 50 to 75.
Right.
And so I think that's what we saw, was that those puts got very cheap on a relative basis given all the uncertainty. And again, it's easier to go from 10 to 15 than 50 to 75.
Right. And so do you have a sense, I guess, kind of in the same way of the TDEX, and I suppose we could just download this data and do a little back testing and playing around, but do you have a sense as to, when you get this type of a magnitude of a move, right, it's kind of like, peak bearishness, so to speak, or the idea is that, the puts, or like VIX going to 80, right? Like, well, no one's going to necessarily want to buy puts at 80 because they're probably never ever going to pay off. Of course, if VIX goes to 200, then of course it'll pay off. But you get kind of understand what I'm getting at, that this is a measurement of sort of extreme fear, right? In the same way that maybe a volley spike or a VIX spike would be.
Well, again, going from 10 to 15 is a big move. It's a 50% move, but I still don't think at 15 TDEX is particularly elevated. Mm-hmm. I mean, these somebody is bidding to buy those options, those deep out of the money SPY puts. That's how it got up there. Yeah. And so somebody's willing to pay that for those. I don't. It's a big move, but I would have a tough time getting very fired up about TDEX at 15.
I don't know why. I don't know if this would make any sense, but off the top of my head, I said the volley to TDEX ratio. I'm not sure if that's actually informational or not.
Well, but this does kind of show the fact that for a long time, if people wanted to buy options, they were going to buy at the money options. They weren't going to buy deep out of the money puts.
Right. It's interesting all the different ways you can adjust all this and play around with it. Quite fascinating. So, we should open up for some questions here. If you guys want to enter some questions, please use the Q&A section. I know we answered a couple kind of as we were going. I was checking those off, some things we addressed. So please pop them in the chat section there. You also have a book that you wrote. I don't know if you want to talk on that for a second. I personally have. I got to order this one up. It's called The Anxious Investor. You want to just give a little background on what that is?
Right. Yeah. Thank you very much. I've actually been able to publish 4 books. The Anxious Investor is the most recent one. The one in 2017 was a history of the United States in 5 crashes. That was a general interest history of the modern stock market crashes. But The Anxious Investor came out in April. The timing is fortuitous. I wish I could say I planned it this way. But the Anxious Investor is an analysis. I wouldn't even say analysis. That's too highfalutin a word. The Anxious Investor looks at all of the behavioral biases. I talk about 15 specific ones in the book. Talks about the behavioral biases that investors display whenever they're dealing with money. And Brent, the problem is that of the 15 biases that I talk about in the book, none of them, not a single one, improves your investment returns. Every one is damaging. And so in the scope of talking about those 15, I look at them through the context of 3 famous stock market bubbles and collapses. And so the goal is for people to see maybe themselves a little bit in what people were doing. And they might say, I don't fall for that bias and I don't fall for that bias. But boy, this one that he talks about, that's me. I recognize myself there. And so that when people are making investment decisions, they can focus on the biases that they're most likely to fall for. And the problem is that so many of them are just natural, the way the fact that we're human.
Yeah.
You think you're doing the right thing. And I try to show in the book, without beating up people, that your biases are not your friend. Right.
So if you had to pick sort of one that you could think of that in this environment where, there's a lot of fear and it's starting to clearly people are buying that tail risk, right? So if you had to sort of focus on one bias, is there one you could say right now that people are probably extra sort of heightened, the risk of falling to that bias is extra heightened?
Yeah, there are actually, I'm going to talk about 2 because they're very similar. They're related. One is recency and the other one is availability. So recency bias is our tendency, our human tendency to believe that whatever has happened recently is normal. And we know that what has happened recently in the stock market is not normal, but we think it is. And so we think it's going to continue. And so people pull the plug and sell because they just can't take any more pain. And availability is the same sort of thing. It's the tendency that people have to believe that whatever is available to memory, whatever they can recall, is normal. And we know that that's not the case. If you can remember it, and it happened more than, say, a month ago, then it is almost certainly not normal. But that's what happens. And as an example of recency, I use some equity mutual fund data from February and March of 2008. And those months saw the biggest equity mutual fund outflows in decades. So that means people sold at the absolute bottom. And then if you use that same flow data, we know that they didn't get back in until years later. But they thought that, market's been down a bunch. I think that's going to continue because it's recent. And as I also point out in the book, there's no such thing as momentum in the stock market. If you calculate the autocorrelation of the Dow going back to 1896, that number is effectively 0. There's no correlation from one time period to another.
And I think that's particularly interesting. I happen to just think about, realized volatility as we're talking about realized vol. And I've been talking a lot about the fact that if you look at realized volatility this year in the S&P, it's higher. It's holding at a sustained level that's higher than at any point in the last 10 years. We had a few episodic spikes, so to speak, but the sustained volatility that we've experienced this year is almost become, I think, in a way normalized to people, right? And I think the market adjusts to that in the same way that I think traders could as well. Now we're all just used to the fact that markets move around 1 or 2% on any, on a given basis, and I think adjust to that in a weird way. And I think eventually it's going to hurt people because they may be, may pay pay too much for options, or it'll be this weird transition period that I think throws a lot of people off.
Yeah, one thing we do know about volatility is that it's heteroscedastic, and that means that markets are more volatile than normal for a period of time, and then they get less volatile than normal for a period of time. And that is that volatility bunches. We don't see a really, really volatile day followed by a very quiescent day. That's just not the way volatility works.
Right. Yeah, you definitely get this clustering effect oftentimes.
Right.
But here the bar has like it's a new lower bound, so to speak.
Yeah.
Which I think is really quite interesting. Jay here asked a quick question. He said, "Can you provide one or two trading use cases here in some of your indices? Is there something that you could say, hey, this is a common thing? I mean, I know you mentioned before that the TDEX gives a lot of interesting information if you kind of backtest that. But is there another metric that you look at that may be a good leading indicator of market movement or something to help people trade?
Well, this term structure, and again, we don't provide term structure on an intraday basis, but when term structure or term DEX gets very negative, that is when the best fit slopes strongly from upper left to lower right, that does tend to mark lows in the market, lows in the S&P. And you can see some of that on that term DEX fact sheet. So that's one way I would think about using it. Another way is to use VOLQ derivatives, futures and options, to hedge a portfolio that looks a lot, the NASDAQ 100. So there are 3 expiration months that are available in both futures and options. And the final thing I'll say is that, and this is, I think, is probably the most interesting trade, although compliance is going to make me say this is not a trade recommendation. So we pay particular attention to the basis for VOLQ versus the basis for VIX. What's the basis? It is the index minus the futures price. And so as an example, Q futures are trading above the index level, while VIX futures are trading below the VIX futures level. And so that's one way that you can take advantage of that basis.
Oop, I just did that the wrong way. I want to do this minus VOLQ. There we go. So this is essentially that basis. I'm not sure if TradingView is probably not the best platform to view that spread on, but that's quite interesting. So look at the basis again, the VOLQ and the VOLQ futures versus the VIX and the VIX futures.
Exactly. And given that VOLQ is earlier today, that spread was to almost 2 points. So Q futures were about 80 cents above the index. VIX futures were about $1.20 below their index. And so the obvious way to take advantage of that is to sell VOLQ futures and buy VIX futures. The multiplier in VOLQ futures is only $100, so you do have to do 10 VOLQ futures for 1 VIX future. But that's one way to take advantage of the fact that both of those futures contracts are going to converge on the index value at expiration, and they both settle at the same time on the same Wednesday. That's 30 days before the next month's expiration.
Yeah, that alone, the fact that the multiplier is smaller, I think is probably a big attractor for a lot of people as they get more used to sort of trading the volatility environment. Specifically.
Yeah, VOLQ futures, the ticker, and they trade at the CME. Ticker symbol is VLQ, and the multiplier is $100. So if you have a point of view and you want to kind of get your feet, and the markets are always 10 cents wide, then there's a way to express a point of view and do it in a reasonable size.
And do you have a static sort of a relationship or ratio if you're long, say, a portfolio of NASDAQ, let's just say the triple Qs, how many futures you want to consider, or do you have a sort of some way to advise people on the number of futures they would want to consider buying VOLQ futures if they wanted to hedge out the volatility of their, let's say, QQQ equity position?
It's a good question because Q is a product of another company. I'm not certain I want to go there.
Or if there's an equity notional maybe amount.
Yeah, I would, if you look at the VOLQ fact sheet on our website, you'll see the correlation value to the NASDAQ 100. And that's probably that's probably how people should approach that.
Okay, so that would be the center box here.
No, volatility indexes. So one big tab to the left. There you go. Look at the VOLQ ticker or the VOLQ fact sheet. And you'll see there what the historical correlation is.
Perfect. So there you go. So that's how you can calculate some hedging ratios if you're so interested in that.
Yep. Yep.
And then we'll field one more question here. I know you're a busy guy, so we'll field one more. I really want to thank you for your time. Paul here asks, how might an options seller think about some of this information or some of the ways to take advantage of it? I don't know if there's something that you would really necessarily change based on, you've already given us a few tidbits in this, but I don't know if there's something in specific. I mean, we have a lot of people, and obviously selling premium is really quite a popular strategy out. You know, if this says anything about calendars or other ways you can think about maybe wanting to sell options in a portfolio. So say, for example, maybe what Skew is telling you or something along those lines.
Well, let's look at VOLQ first. The general level of VOLQ will tell me whether or not, say, selling VOLQ options makes a lot of sense. I would never sell those if VOLQ's at 10, or at least I wouldn't sell upside calls, certainly, because that doesn't make too much sense. Q's never going to fall much below 10. It's just not. We know volatility has a lower bound and it's mean reverting. I would say that in a situation like that, when VOLQ is relatively low, then selling call spreads makes sense. That is, we're going to collect some premium, but we're going to limit our upside. And you know, we get into a situation like this where VOLQ is at 35 or so, or actually quite a bit higher today, then I still think that selling call spreads makes a tremendous amount of sense in a volatility product. It's just a good way to collect premium, define risk, but, you know, recognize that volatility is mean reverting and it's not going to stay at 35 forever.
Right. And I think that also sort of dovetails with this backwardation. It's hard to sustain this, in my view, because the relative expense of these short-term options, they got to come down. And so I think oftentimes considering selling, you know, maybe put spreads in this environment, again, not investment advice, but to me, that's just something to think about, because even if, you know, we sustain this longer dated level of vol, say 27, 90 days out or something, you can get a real, very quick flattening, right, of this curve, which would represent, you know, the decline in implied volatility of short-term spiders.
Right. And, you know, so calendar spreads in VOLQ options would be another way to take advantage of the same sort of thing. So if you were to sell, you know, the October 40 call and buy the November 40 call, well, you've defined your risk, but you're also taking advantage of the fact that everybody wants short dated and nobody cares too much about longer dated. A calendar, doing a calendar like that again would be a way to define risk by taking advantage of all those situations.
Right, that makes a lot of sense. And those, and the VOLQ futures have options listed on them, right? So if you, Paul's asking as well, you can, like in Thinkorswim, I'll just type /VLQ and I'm able to bring up the VOLQ index. And is that how I get at those options as well?
/VLQ will bring up the futures, and the ticker for the options is VOLQ. So just like in the VIX world, the options and the futures are both derivatives on the index. So the options are not options on the futures, they're options on the index. So /VLQ for the futures, and and VOLQ for the options, and that's on Thinkorswim.
Yep, I was just able to pull those up myself. So
yeah,
so that's great. Well, Scott, you know, this has been a wealth of information. I really appreciate it. It's really cleared up some of the thoughts and ideas I've had around how to use some of your different products, and also opened my eyes to some new things. I'm definitely going to be downloading the TermDex data and playing around with that. Anything else, you know, people can get a hold of you at Scott Nations. Anything else that people should know here before we sign off?
You know, just the best way for people to get a hold of me is through Twitter. Actually, I'm generally really good about interacting and answering questions. That's just a great way to get hold of me is through Twitter. I love to interact with people on Twitter, and it's a good way for us to share charts of what's going on or thoughts or that sort of thing.
That's great. Thanks so much. And we'll be pushing this video out to YouTube so everyone can watch it up there, and then also breaking it into some smaller pieces that, you know, specifically talk about some of these different features. So all that for everybody listening will be pushed out in the next couple of days.
Well, thank you, Brent. Thank you for having me.
Yeah, it's been great talking to you, Scott, and we'll talk to you again very soon.
Thanks so much.
Take care.